Here is a fact that shocks most Americans the first time they learn about it. Moving abroad does not get you out of paying US taxes. In fact, the United States is one of only 2 countries on earth that taxes its citizens regardless of where they live. That means whether you are sipping coffee in Paris, teaching English in Bangkok, or running a business from a beach in Bali, the IRS still expects its cut. Americans moving abroad have no idea this is the case, and it costs them thousands of dollars in penalties, interest, and legal headaches. If you're an American thinking about moving abroad, or if you've already made the move, this video might be the most important one you watch this year. The US operates on a citizenship-based taxation system. That means as long as you hold a US passport, the IRS considers you a taxpayer, regardless of where you live, where you earn your money, or how long you've been gone. You could live in Thailand for 20 years and never set foot in America, and you'd still be legally required to file a US tax return every year. The good news, you probably won't owe as much as you think, thanks to a few powerful exclusions and credits that most Americans abroad qualify for. The bad news, the rules are complicated, the penalties for getting it wrong are severe, and the reporting requirements go far beyond just your income. In this video, we are breaking down everything you need to know in plain English. No jargon, no accounting speak. Just the facts, what you owe, what you can exclude, what you have to report, and the mistakes that get Americans abroad into serious trouble. We are not tax professionals, and this isn't tax advice, but this is the starting point every American expat needs. Let's start with the most important protection every American abroad needs to understand: the Foreign Earned Income Exclusion. The Foreign Earned Income Exclusion, or FEIE, allows qualifying American expats to exclude a significant portion of their foreign earned income from US federal income tax. For the 2026 tax year, that exclusion amount is $132,900 per person. If both spouses work abroad and qualify, the combined exclusion is $265,800. This is a permanent provision, made permanent by the One Big Beautiful Bill Act signed in July 2025. To claim the FEIE, you must file Form 2555 with your tax return, and you must meet one of 2 tests. The physical presence test requires you to be physically present in a foreign country or countries for 330 full days during any 12-month period. The bona fide residence test requires you to be a genuine resident of a foreign country for an uninterrupted period that includes an entire tax year. Here is where digital nomads and frequent travelers get caught. Partial days in the United States count against your 330 days. If you spend Thanksgiving, Christmas, and a few long weekends back home, you can easily fail the physical presence test without realizing it. Your tax home also matters. If you move frequently without establishing a fixed base abroad, the IRS may determine your tax home is still in the United States, disqualifying you from the FEIE entirely. The FEIE applies to earned income, wages, salaries, bonuses, and self-employment income earned while living and working abroad. It does not apply to passive income. Pensions, dividends, rental income, capital gains, and interest are not eligible for the FEIE and are taxed at normal US rates. Now let's talk about the second major protection, the foreign tax credit. The foreign tax credit gives you a dollar-for-dollar credit against your US tax liability for income taxes paid to a foreign government. If you live in a high tax country like the United Kingdom, Germany, France, or Spain, this credit often eliminates your entire US tax bill. You claim it using Form 1116. The strategic question is, which protection should you use? The answer depends entirely on where you live and how you earn. If you earn under $132,900 and live in a low tax or no tax country like the UAE, Singapore, or certain Caribbean nations, the FEIE is your best tool. It excludes your entire earned income from US taxation, and the process is relatively straightforward. If you live in a high tax country, the foreign tax credit is usually better. Since you are already paying substantial taxes locally, the credit wipes out your US liability. In many cases, expats in high tax countries end up owing zero US federal income tax. If you earn over $132,900, you should use both. Exclude the first $132,900 with the FEIE, then apply the foreign tax credit to any remaining income taxed at the foreign rate. Now here is a trap that catches self-employed Americans every single year, and it is genuinely expensive. The FEIE eliminates income tax on your foreign earnings, but it does not eliminate self-employment tax. If you are self-employed abroad, you still owe 15.3% on net business income for Social Security and Medicare up to the Social Security wage base of $176,100 for 2025. That is $26,943 in self-employment tax that the FEIE does not touch. However, if your host country has a totalization agreement with the United States and you are paying into that country's social security system, you may be exempt from US self-employment tax. Countries with totalization agreements include the UK, Canada, Australia, Germany, France, Spain, Italy, Japan, South Korea, and many others. You must obtain a certificate of coverage from the Foreign Social Security Authority to claim this exemption. If you are self-employed in a country without a totalization agreement, you are paying both local social contributions and US self-employment tax. That is a genuine double tax that requires careful planning. Let's talk about the reporting requirements that terrify more expats than the tax itself. FBAR, the Foreign Bank Account Report, requires you to file FinCEN Form 114 if the aggregate value of your foreign financial accounts exceeds $10,000 at any point during the calendar year. This includes checking accounts, savings accounts, investment accounts, pension accounts, and even accounts you have signature authority over but do not own. The penalty for non-willful failure to file can be up to $10,000 per violation. Willful violations can result in penalties of the greater of $100,000 or 50% of the account balance. FATCA, the Foreign Account Tax Compliance Act, requires you to report specified foreign financial assets on Form 8938 if they exceed certain thresholds. For single filers living abroad, the threshold is $200,000 on the last day of the year or $300,000 at any point during the year. For married filing jointly, it is $400,000 and $600,000. These thresholds are significantly higher than FBAR, but the penalties for non-compliance are severe. Here is something most Americans do not realize. Moving abroad does not automatically end your state tax obligations. States like California, New York, Virginia, and New Mexico are notoriously sticky. They may continue to tax your worldwide income even after you leave the United States, claiming you still have domicile ties. Most states do not recognize the FEIE, meaning income you excluded at the federal level may still be subject to state tax. Properly changing your state residency before you leave can save thousands of dollars annually. This means establishing a new domicile in a no-tax state like Florida, Texas, or Nevada before your departure. Cutting ties with your old state and documenting everything. For 2026, several tax changes affect Americans abroad directly. The standard deduction has increased to $16,100 for single filers and $32,200 for married couples filing jointly. Taxpayers aged 65 and older can claim an additional $6,000 deduction or $12,000 for married couples where both qualify, though this phases out for modified adjusted gross income above $75,000 single or $150,000 joint. For foreign business owners, the tax landscape shifted significantly. The net CFC tested income regime replaced the former GILTI tax effective January 1, 2026. The effective tax rate increased from 10.5% to 12.6%, and the prior QBI exclusion was eliminated. If you own 10% or more of a foreign corporation, you must file Form 5471, which carries a $10,000 penalty per year for non-filing. Most expats can still eliminate this tax through the high tax exception if their foreign corporation pays a local rate of at least 14%. Now let's address the most common question I get. Do I need to hire an expat tax professional? If your situation is simple, one job, one country, income under the FEIE threshold, no foreign accounts over $10,000, you can probably handle your own filing with quality tax software designed for expats. But if you have any complexity, self-employment income, foreign business ownership, rental properties, investment accounts, or you are unsure about your state residency status, the cost of professional advice is almost always worth it. A single missed FBAR filing can cost more than a decade of accountant fees. The automatic 2-month extension to June 15 for Americans living abroad still applies with no form required. But remember, this is an extension to file, not an extension to pay. If you owe taxes, interest accrues from April 15. If you need more time, you can file Form 4868 for an additional extension to October 15. Here is the honest truth about American expat taxes. The system is complex, the penalties for mistakes are severe, and the ears does not care that you find it confusing. But with proper planning, most Americans abroad owe little to no US federal income tax. The FEIE, the foreign tax credit, the foreign housing exclusion, and totalization agreements are powerful tools if you use them correctly. The Americans who get into trouble are the ones who assume that living abroad means they do not need to file, or who try to wing it without understanding the rules. Do not be that person. The cost of ignorance is far higher than the cost of compliance. If you found this video valuable, please hit that like button because it helps reach more Americans abroad who genuinely need this information. And if you have a specific tax question, drop it in the comments. While we cannot give personalized tax advice, we can point you toward the right resources. Subscribe for more content on the practical realities of living abroad, because we do regular deep dives into relocation destinations and issues that may affect people wishing to move abroad. Your life abroad should be financially smart, not a tax nightmare. Make sure you have the information to keep it that way.